Welcome to another playlist where I review my portfolios with low, medium, and high dividend yields. It's been 2 months since I created them, so let's take a look at the results. First, our low dividend yield portfolio has shown excellent results over the last 2 months, with profits reaching $1,056. You can see the companies in this portfolio that contributed to these results. Notably, during this economic downturn, quality stocks like Walmart, JP Morgan, and Home Depot have surged. This trend is largely due to uncertainty about the future, prompting investors to seek assets likely to survive a recession. This makes sense, as many companies are currently laying off workers or reducing production. Companies like Walmart can grow during this time due to their robust business model. One notable performer is Lamb Weston, which brought in 37% profit. However, I believe this company is currently overvalued, as they have little control over the closure of restaurants, which could lead to reduced profits. Thus, I anticipate a slight decline in their stock price in the near future. T-Mobile also saw gains after management announced a dividend increase. The only company that brought significant losses to this portfolio was FedEx, which had a return of -6% or -$16, a relatively minor setback compared to the overall capital. Overall, our portfolio has already received $30 in dividends, bringing the total profit to $1,086, with 3 more payments expected by the end of this month. Comparing profits to the S&P 500 index, we are slightly ahead by $100. Our dividend yield is slightly higher than that of the S&P 500, so we can consider our performance superior to that index. Moving on to our second portfolio with medium dividend yield, it generated only $198 in profit, making it the least successful among all of them. Almost none of the companies I hold produced significant results, with Cisco being the exception. Additionally, the fund in which I invested over 26% of the total capital, BND, means that the yield will largely depend on bond performance and how quickly interest rates are cut to save jobs. We've already seen a 50 basis point cut, and I still expect the Fed to continue this policy to at least 4%. As for the other companies, there's not much to expect, as most of them are dividend aristocrats, meaning they won't experience rapid growth or decline. We received $54 in dividends over the last 2 months, bringing our total profit to $252. I don't think we need to compare this portfolio to the S&P 500. As the results are, to put it mildly, poor, just as expected. Lastly, our high dividend yield portfolio brought us $539 in profit. I've mentioned before that this is my riskiest portfolio, and it seems I just got lucky with these results. As I'm not particularly fond of most companies on this list, except for a few like AT&T, most of the assets carry significant risks, which is why they pay such high dividends. I received $64 in dividends over the last 2 months, giving us a total profit of $603. Of course, the results are worse than the S&P 500 index, as this portfolio is aimed at high dividend yield rather than growth. In summary, all portfolios are fulfilling their functions. The first portfolio with low yield in terms of dividends is not trailing the S&P 500. The second portfolio is focused on capital preservation and slight growth to outpace inflation. The third portfolio is the riskiest, targeting high dividends, and thus has high volatility. This month, it worked in our favor, but even with this luck, we still can't catch up to the S&P 500 index. That's all for today. Subscribe to the channel to follow these portfolios. Maybe you'll find some stocks that you like.